Hi, Juliana. Yes, so we are not expecting this rally to be sustained. Now, whether or not it's going to end right now, there's a lot on depending on the technicals, but there's also a lot of momentum in the market at the moment. You almost need to have some kind of catalyst in order to change direction. And for the time being, I think we may actually, as you said, we may have to wait until September or potentially until the end of August, when maybe we hear a little bit more from Powell with a slightly more hawkish sense to really convey to the market that even if there is a slowing in the economy, if inflation pressures are still high, they will have to continue hiking rates. And if we get that, then I think that you could have that turnaround and the market rally will come to an abrupt halt and then you get new falls.
So how are you thinking about positioning then? If we are not necessarily going to get a catalyst till the end of August, September, is it, just hold fire until then? Or are there ways to continue to put money to work, places where you could potentially hide out?
Yeah, so I think this is a difficult time for positioning. I mean, we have stayed neutral equities because of the concerns that you could see something of a bear market rally during the summer months. So we didn't move to that underweight position in recognition. Now, at some point, when we do feel like that catalyst has come or is about to come, then certainly at that point, we could move to an underweight on equities. But there are other things within the asset allocation complex that you can focus on. So, for example, within fixed income, we are slightly to a more defensive position, but we do like a lot of the core fixings. And that's, of course, that's treasuries, but also a lot of securitized debt because you take out the credit element. But more importantly, I think still real assets are the key to gains at the moment. The inflation problem to us, it's not disappearing anytime soon. We've seen the peak of inflation, but that doesn't mean that it's going to go away very quickly. We think it's going to be a very slow decline. So in that environment, you still want to have exposure to things like listed infrastructure, which typically outperforms in a slow economic growth environment, but a high inflation time.
Seema, there are reports that some of the fund managers are being dragged back into this market because of that extent of the rally, 17% off the lows for the S&P 500. So based on the caution that you're saying be careful of being sucked back into this rally. And is that possible, though, if we've had such big gains and there's been such big downsides for some fund managers? Do you think they are going to actually stay on the sidelines?
I think they will. I mean, look, this is not unusual. In any long equity market decline, through history, we have seen about 6, 7, 8 times that you've seen a bear market rally within that longer period of falls. So this isn't unusual. And typically, actually, the kind of gains that we've seen in the last couple of weeks are not unusual. So I think it's important to kind of, I know it's very difficult. You want to capitulate because, of course, there are going to be concerns growing that we've already seen the bottom for the market. But I think it's important to focus on the fundamentals. And the fundamentals are telling us that there is a slowing economy, which means that earnings growth is going to be under pressure. And so the inflation outlook, because it's still so sticky, the Fed and other central banks are going to have to continue raising rates, which unfortunately does mean that the stock market rally will eventually run out of steam.